If you watched the last video, you already have the structural map. The Federal Reserve 8-to-4 split, the 13.4% COMEX coverage ratio, China's licensing regime, India's DGFT freeze, Saudi Arabia and Russia rotating into silver as sovereign reserve metal, Mexico's cartel inheritance fight, Project Vault, the Hormuz oil shock. This video is not a rerun of those 8 fractures. This video is the 8 new fractures that sit underneath them. Every data point I'm about to walk you through is fresh. Spot silver closed Friday at $81.33 per ounce per Fortune's daily benchmark. That is a 2.78% move in 24 hours, a weekly gain of over 7%. The highest level since mid-March, per Trading Economics intraday tape on the 8th of May. Bank of America's published 2026 silver target was $65 per ounce. The market has now traded 25% above that target. BNP Paribas' published end-of-year 2026 target is $100 per ounce. We are $19 away. Hold those numbers, because the 8 fractures I am about to walk you through are the reason every major bank target on Wall Street is now sitting behind the price tape, not in front of it. Stay with me. Per the published investing.com analysis dated October 2025 and reaffirmed in subsequent BofA commodity research, Bank of America's analysts described silver breaking $50 per ounce as, quote, not merely a technical event, but a necessary repricing mechanism to balance global demand with constrained supply. Read that sentence again. Necessary repricing mechanism. That is the language a major Wall Street bank uses when it is signaling to its institutional clients that the prior price band was a structural error. Bank of America became the first major financial institution to publish a $65 2026 silver target with an average forecast of $56.25 per ounce. Both numbers were cleared in the first quarter of 2026. The price has now traded 25% above the high end of that target. Now layer the BNP Paribas call. Per the published Ainvest research summary citing BNP Paribas commodity strategy, the bank suggests prices could climb to $100 per ounce by the end of 2026. With silver trading at $81.33 on Friday, that target is 23% away. Now Goldman Sachs. Goldman is also bullish on precious metals, but has publicly warned of, quote, greater volatility and downside price risk for silver compared to gold, noting silver lacks the central bank buying support that has provided a floor under the gold price. That published Goldman caveat was issued before the Saudi Arabian Monetary Authority 13F disclosure of SLV holdings and before the Russian Federal Treasury silver allocation. Both of those events have happened. The central bank floor Goldman said silver did not have is now being publicly assembled. The first cliffhanger is that the major sell-side desks have published their highest silver targets in modern history. Bank of America's $65 target has been blown through. BNP Paribas has $100 in print. And Goldman's specific objection to the silver bull case, the absence of central bank demand, has been falsified inside the last 9 months. The price is doing what the published research said it would do, except faster. Stay with me. Per published commentary from Bank of America's Commodity Technical Desk, silver has executed a confirmed breakout from what their analysts describe as a 45-year cup and handle pattern. That technical formation began forming in 1980, the year of the Hunt brothers' silver squeeze peak, and completed in late 2025. Read that on the timeline. 1980, 45 years of consolidation. A cup and handle on a 45-year chart is not a swing trade signal. That is a generational reset of the price band. The technical pattern measure target, calculated by taking the depth of the cup and projecting it from the breakout point, implies a price target in the multiple $100 range. I'm not making the price call. I'm telling you what the published technical research says. Bank of America's analysts put it on the wire. Now overlay the futures curve structure. Per published market structure research from investing.com and confirmed by the Bullion Star Structural Analysis, dated January 2026, every COMEX silver futures contract through late 2026 is trading below the current spot price. The entire forward curve is in backwardation. That is not a transient quirk. That is the market explicitly pricing physical scarcity that lasts years, not weeks or months. The $2.88 backwardation print referenced in the Metals Edge published market analysis is the steepest inversion in over 40 years. Not since the early 1980s has the front-to-back spread on silver been this wide. Now, the lease rate detail almost no Western desk leads with. Per the published investing.com market structure note, London silver lease rates spiked to 39% on the 9th of October 2025 before moderating to 11%. To put that in perspective, typical historical lease rates run below 1%. 39% is not just unusual. It is the sound a vault makes when the metal inside has been promised twice. The second cliffhanger is that a 45-year technical breakout, deep persistent backwardation across the entire forward curve, and lease rate prints that briefly cleared 39% are all telling the same story. The paper-to-physical link in the silver market is not just stretched. It is structurally cracked, and the technical chart just confirmed the band the market has been trading inside since the year I was born is no longer the band we are in. Per the Bullion Star published market structure analysis dated January 2026, physical silver pricing on the Shanghai Gold Exchange has decisively broken away from Western paper benchmarks. The published premium reaches approximately 12 to 13% above LBMA spot and COMEX futures prices. 12 to 13% on the same metal, same purity, same physical bar. A premium of that magnitude is exceptionally high by historical standards. It places current conditions among the most extreme divergences observed in the modern silver market. And here is the part the cable desk will not say out loud. When two exchanges price the same metal that differently, that is no longer one global market. That is two markets pricing two different commodities. Shanghai is pricing physical silver. London and New York are pricing paper claims on physical silver. The premium is the gap between the two definitions. Per the published McAlvany financial commentary dated October 2025, hundreds of tons of silver have been physically moving from New York COMEX vaults toward London LBMA vaults to relieve the squeeze. The metal is in motion, but the metal in motion is not catching up to the demand that is asking for it. David McAlvany walks through a hedge desk example on the public record that I want to read to you carefully. A hypothetical 50,000 ounce silver hedge position over a single weekend in October 2025 cost the holder approximately $145,000 in incremental hedge cost. That is between 5 and 6% of the position value in 48 hours, just for the privilege of being hedged through a weekend in a backwardated market. This is what happens when the carry math inverts. Hedging is supposed to reduce risk. In a deeply backwardated, high lease rate market, hedging becomes the single largest source of P&L destruction in your operation. So refiners and producers do the rational thing. They stop producing. They sit on metal. They wait for normal carry to return. Per the McAlvany commentary, it is better for them to do nothing. It is better for them to not produce a product. The third cliffhanger is that the Shanghai LBMA premium is the visible price tag on a single global silver market splitting into two. And the production response to the splintering is rational refiners refusing to refine, which means the supply pipe constricts further while the premium widens. Stay with me. Per the Bullion Star published structural analysis, citing Silver Institute and Metals Focus historical mine data, global silver mine production peaked in approximately 2016 and has declined since. Approximately 70% of all silver produced annually comes as a byproduct of base metal mining, primarily copper, lead, and zinc. Stop on that number. 70% of all silver comes out of the ground attached to other metals. This matters because higher silver prices alone cannot bring new supply online quickly. A copper mine does not change its production schedule because silver hit $80. A zinc mine does not double its throughput because the silver byproduct just doubled in value. The economics of the host mine, copper, lead, zinc demand, base metal pricing, ore body characteristics, drive the production decisions. Silver is along for the ride. This is the structural ceiling on supply response that the price elasticity bears do not properly model. In a normal commodity market, when the price doubles, supply expands. In silver, when the price doubles, only the 30% of supply that comes from primary silver mines responds. The other 70% stays bolted to base metal economics that have nothing to do with silver demand. Now overlay the mine response that is happening. Per the published reporting from Carbon Credits, dated April 2026, BHP, the world's largest mining company by market capitalization, signed a streaming agreement with Wheaton Precious Metals for $4.3 billion upfront. In exchange, BHP transfers the silver byproduct stream from its share of the Antamina copper mine in Peru to Wheaton. Read what just happened. The world's largest mining company took $4.3 billion in upfront cash to give up its forward silver production. That is not a bullish miner holding silver on its balance sheet. That is a miner converting forward silver into immediate liquidity. It is a corporate finance signal that BHP's treasury looked at the forward curve, looked at the streaming deal economics, and decided that $4.3 billion in cash today was preferable to holding the silver byproduct for the next decade. Either BHP knows something about the price ceiling the rest of us do not, or BHP is making a structural mistake. I'm not in the room. I cannot tell you which. But Wheaton is on the other side of that trait. And Wheaton's published view is that streaming silver at this price band is one of the better deals it has ever signed. The fourth cliffhanger is that 70% of global silver supply is bolted to base metal economics that do not respond to silver prices. The 30% that does respond is being structurally monetized into upfront cash by major miners. The supply ceiling is harder than the demand-side analysts model, and the corporate finance signal from the largest miner on the planet is that the next decade of silver production is being sold forward today. Per the Silver Institute press release dated the 10th of February 2026, total global silver exchange traded product holdings stand at approximately 1.31 billion ounces. Per the Silver Institute's revised 2026 supply forecast, total global silver supply for the year is now forecast at 1.05 billion ounces, a decade high. Do the math with me. 1.31 billion ounces locked inside ETP wrappers. 1.05 billion ounces of total annual supply. The ETP holding pool is 1.25 times the entire annual supply pipeline. Read that sentence one more time because I want to be sure it lands. Investors holding paper silver claims through ETPs hold more silver than the entire planet will produce in 2026, including recycling. This is not a stable structure. In normal commodity markets, ETF holdings represent a fraction of annual supply. They function as marginal demand. In silver, ETP holdings have become the single largest above-ground stockpile of allocated metal in the world, and they are sitting in a market structure where the underlying physical metal is being asked to leave Western vaults and move to Shanghai. Per the published Bullion Star analysis, in an extreme squeeze, ETF shares may continue trading while the underlying metal effectively disappears from the market. Investors believe they own silver, but in reality hold a paper claim with growing counterparty risk. I want to be careful here. Not all ETP wrappers are structured the same way. Some are fully physically allocated and audited, some are not. The risk is concentrated in the unbacked or partially backed structures, not uniformly distributed across the asset class. But the systemic risk is real, and it is published in major bank research notes. Per the same Crux investor research dated October 2025, deliverable silver inventories at COMEX and LBMA vaults declined by over 20% year to date. The inventories that backstop the paper market are draining. The paper market itself is growing. The two trend lines are moving in opposite directions, and they have been moving in opposite directions for over 12 months. The fifth cliffhanger is that the global silver ETP pool is now larger than the entire annual silver supply pipeline. The vault inventories backstopping that paper pool are draining at over 20% year to date. Either the metal flows back into Western vaults, or the paper claims and the physical reality eventually have to be reconciled, at a price the published research says is multiples higher than today's tape. Here is a fracture almost no Western financial publication has reported, but which David McAlvany walked through on the public record in October 2025, and which has now been confirmed by published premium tracker data through April 2026. The small format silver market, American Silver Eagles, Canadian Maple Leafs, junk silver bags, fractional rounds, has begun pricing independently of spot. When refiners stop minting new product because the lease rate and backwardation environment makes new production unprofitable, the existing inventory of small format coins becomes the only physical small format supply available, and that inventory is finite, per McAlvany's published commentary. Anything small format could see, over the next 6 to 12 months, a healthy increase in the wholesale market premium. If there is no new product being minted, being manufactured by the refineries, now you're working through the old inventory. It is secondary market product. Translate that into what is actually happening at the dealer level. A typical American Silver Eagle premium over spot in a normal market sits at $2 to $3. By early 2026, premiums on the same coin had widened towards $7 to $9 in some published dealer surveys, and the gap continues to expand as new minting from the United States Mint slows. This matters because the small format market is the entry point for retail physical demand globally. For the average buyer in India, Indonesia, Nigeria, Brazil, the Philippines, silver enters their portfolio not as a 1,000-ounce LBMA bar, but as a coin or a small bar that fits in a household safe. When the small format premium widens permanently, the effective price the global retail market pays for silver decouples from the spot price quoted on cable financial channels. There is now a third silver price emerging. There's the COMEX paper price. There's the Shanghai physical price. And there is the global retail small format premium price. All three are diverging. None of them agrees with the others on what an ounce of silver actually costs to acquire and hold today. The sixth cliffhanger is that the silver market is now functionally three separate markets pricing the same underlying metal at three different price bands. The COMEX paper price is the one cable financial media reports. The Shanghai physical price is 12 to 13% above it. The global small format retail premium price is widening on top of both of those, and the physical buyer in Lagos or Mumbai or Manila is paying the third one, not the first. Here is the news story from this week that almost nobody connected back to the silver thesis. Per Fortune magazine reporting in its weekend edition dated the 7th of May 2026, a Michigan farm town voted down plans for a giant OpenAI Oracle data center. Weeks later, construction began anyway. Read that headline twice because it changes the silver demand model materially. If local Democratic opposition to hyperscale AI data center construction can be overruled by state preemption, federal infrastructure designation, or contract enforcement, then the AI compute build-out proceeds at a pace that local communities cannot break. The Goldman Sachs published projection of 165% growth in data center power demand by 2030 assumes the build-out continues. The Fortune Michigan story confirms that even local rejection does not stop it. Now connect the silver math. Per published industry data referenced in prior segments, approximately 20 metric tons of silver are required per gigawatt of installed photovoltaic capacity. A single 500 megawatt solar array, the kind that powers one hyperscale AI campus, requires approximately 300 metric tons of silver. Per published industry estimates cited in Seeking Alpha analysis dated January 2026, the United States and China combined consumed an estimated 350 million ounces of silver for data center applications in 2025. That is more than 50% of total global mine supply. From data centers, in 1 year, before the AI capital expenditure cycle reached full deployment scale. The Michigan story tells us the deployment cycle is going to keep going regardless of local political resistance. The Goldman 2030 projection tells us the demand curve is steepening, not flattening. The Silver Institute's 2026 demand forecast confirms data centers and AI technologies as primary structural drivers for the rest of the decade. There is a bear case here, and I will get to it in the bear section. The Bloomberg NEF April 2026 photovoltaic silver demand forecast at 194 million ounces represents a 7% year-on-year decline, partially offsetting the data center demand pull. That is real, but it does not erase the data center demand, it modulates it. The seventh cliffhanger is that the AI capital expenditure cycle is structurally bound to silver consumption through its solar power supply chain at roughly 300 tons per hyperscale facility, and the local democratic mechanisms that would slow the build-out are being overruled in real time. The Michigan precedent matters because it is the test case, and the precedent set is that the data center wins. I'm going to spend this fracture on the strongest argument against the silver bull case so you have the full picture, not the cherry-picked one. This desk does not soften the data either way. Per the Bloomberg NEF published photovoltaic silver demand analysis dated April 2026, photovoltaic silver demand for 2026 is forecast at approximately 194 million ounces, representing a 7% year-on-year decline. The reason is the published technology trajectory disclosed by LONGi Green Energy and ICO Solar in their public investor materials. Copper-clad silver paste in heterojunction solar cell manufacturing has progressed from over 50% silver content in the second quarter of 2023 to 15% in the second quarter of 2025 to 10% in products entering production in the third quarter of 2025. Engineering targets cited in the same investor disclosures aim for less than 1 milligram of silver per watt against a current 8 to 9 milligram benchmark. ICO Solar has already shipped silver-free cells. Translate the trajectory. The solar industry is engineering an 85% plus silver intensity reduction in real time. If the engineering targets are met on schedule, the per watt silver requirement in new solar manufacturing falls towards zero by 2028 to 2030. If you take only that data point, the silver bull case in solar collapses. Photovoltaic demand peaks, new technology removes the metal, and the demand side wedge that justifies the structural deficit thesis disappears. Here is why I do not think it is that simple. The silver-free heterojunction trajectory is a forward technology path. It has not yet been deployed at the scale of the existing crystalline silicon solar fleet, which uses silver and will continue to use silver for the operational life of the panels, typically 25 to 30 years. The installed base does not get retroactively desilvered. New manufacturing does, so the silver consumption curve in solar peaks later than the headline forecasts suggest, and the back end of the curve is dependent on Chinese manufacturing volumes that are themselves now subject to export licensing. Also, the data center demand pull I walked through in Fracture 7 is not in the photovoltaic forecast. Data centers buy solar capacity from the existing manufacturing base. They consume silver at the rate of the panels they buy, not the rate of the next generation cells in the lab. The eighth cliffhanger is that the silver bear case has one genuinely strong leg, the engineered intensity reduction in solar manufacturing that is happening in real time and is published in investor materials. It is the only structural counterthesis that is not a price elasticity argument. And even that argument depends on a deployment timeline that runs years behind the data center demand pull driving consumption today. This desk gives the bear case discipline in every script. Silver at $81.33 is sitting roughly 33% below the all-time intraday high of $121.67 printed on the 29th of January 2026. The price hit $73.96 on the 5th of May, 6 trading days before this recording. The $81 print is a recovery rally inside a still broken down trend until proven otherwise. The Bank of America $65 target was published in October 2025. The price exceeded the target. That does not mean Buffett was wrong. It means the price is now above where the most published bullish major bank thought it should be in the median 2026 outcome. Mean reversion is a real risk. Federal Reserve commentary remains hawkish. The 8-4 split on the 29th of April included voices that dissented in the direction of higher rates, not lower. The 7th of May ADP private payrolls report, cited in published U.S. Gold Daily Review, showed the United States economy added 115,000 jobs in April 2026, exceeding economist forecasts of 62,000. A resilient labor market argues against the rate cut path the silver bull case partially depends on. Photovoltaic silver demand declining 7% year on year is real demand destruction. It is happening now, not in some future technology scenario. The Iran one-page memorandum has not been signed. Tehran's response is expected within days. If the memorandum is signed and Hormuz reopens cleanly, energy CPI rolls over, the inflation argument weakens, and the safe haven premium in silver compresses. The ETP holdings figure of 1.31 billion ounces is the same number that, if the trade reverses, becomes the largest concentrated forced selling pool in the silver market's history. A 10% ETP outflow is 131 million ounces of selling pressure, more than 10% of annual mine supply hitting the bid in a single quarter. That has happened before. It can happen again. SLV exchange traded fund flows show 1-month net outflows of approximately $590 million and 3-month net outflows of approximately $1.39 billion per the recent ETF database read. That is documented capital exiting paper silver, not entering it. The bear case is real. I'm not softening it. Here's what the data says as of the 8th of May 2026. Spot silver, $81.33 per ounce per fortune. Weekly gain over 7%, year-to-date appreciation roughly 13%. Year-on-year appreciation approximately 144%. All-time intraday high $121.67 on the 29th of January 2026. Bank of America 2026 silver target $65. Current price 25% above the target. BNP Paribas end of 2026 target $100 per ounce. Distance to target approximately 23%. 45-year cup and handle technical breakout confirmed by Bank of America Technical Research. Front to back COMEX backwardation $2.88, steepest in over 40 years. Forward curve through late 2026 trading entirely below spot. London silver lease rates spiked to 39% on 9th of October 2025, moderated to 11%. Historic norm under 1%. Shanghai Gold Exchange physical silver premium over LBMA spot 12 to 13%. Global silver ETP holdings 1.31 billion ounces per Silver Institute 10th of February 2026 release. Total global silver supply forecast 2026 1.05 billion ounces. ETP to annual supply ratio 1.25 times. Deliverable silver inventories at COMEX and LBMA declined over 20% year to date. Byproduct mining share of global silver supply approximately 70%. Primary silver mine response capacity approximately 30% of total supply. BHP Wheaton Antamina silver streaming deal $4.3 billion upfront, April 2026. Small format coin premiums widened from $2 to $3 in normal markets to $7 to $9 in early 2026 dealer surveys. Bloomberg NEF photovoltaic silver demand forecast 2026. Approximately 194 million ounces, 7% year-on-year decline. ICO solar silver free heterojunction cells. Shipping. Long Eye heterojunction silver paste content trajectory. 50% in Q2 2023 to 10% in Q3 2025. OpenAI Oracle Michigan Data Center. Local vote rejected. Construction proceeding regardless per fortune. 7th of May 2026. US plus China. Combined data center silver consumption 2025. Estimated 350 million ounces. ADP April 2026. Private payrolls. 115,000 jobs added against 62,000 forecast. SLV 1-month net outflows approximately $590 million. 3-month net outflows approximately $1.39 billion. Bank of America's $65 2026 target was breached. BNP Paribas has $100 in print and the price is $19 away. The 45-year cup and handle just confirmed. The Shanghai LBMA premium is 12 to 13%. Global ETP holdings exceed annual supply by 25%. 70% of silver supply comes out of base metal mines that do not respond to silver prices. The world's largest miner just monetized its forward silver byproduct stream for $4.3 billion. Small format coin premiums have widened threefold. A Michigan town rejected a hyperscale AI data center and this construction started anyway. And the bear case has exactly one strong leg, engineered solar silver intensity reduction, and even that leg runs years behind the data center demand pull driving consumption today.